If you can find undervalued stocks, you're literally ahead of 99% of investors. And this is really powerful because it allows you to buy stocks for a low price, hold them, and then sell them for a higher price, so that way you can really make a profit. So in this video, I want to share with you the 5 key indicators that you can start using right now, so that way you can spot undervalued stocks effectively. Now you're probably thinking, why the heck should I even listen to this guy? And the answer is this. My name is Guillermo. I'm the CEO and founder of a company called Whitesheets, and we've dedicated this company to help everyday investors like yourself to be able to find good investment opportunities to invest in. And this is something that we do on a regular basis for ourselves, for our clients. So this is really a no BS guide to being able to find those undervalued stocks. And if you stay until the end of the video, or you can also just skip to that part of the video, I'm gonna share with you, as you can see right now on the screen, how it is that you can take a list of companies in your spreadsheet, a list of the metrics that we're gonna talk about in this video to find undervalued stocks, get the data automatically in your spreadsheet, so that way you can really find those undervalued stocks opportunities faster. Okay, so starting with our list, the first key indicator of an undervalued stock is the ROIC, otherwise known as the return on invested capital. This metric is really valuable because at the end of the day, the purpose of a business is to generate a return for the shareholders. And this metric encapsulates that metric and that percentage return really well. There are different ways to calculate this metric, but the typical calculation is this. You take the net operating profit after tax and you divide it by the total invested capital. And of course, this metric tells you the percentage in terms of our return that the company is generating for the shareholders. The higher this number is, usually the better. So really what you're looking for is a company that's generating a healthy return relative on the industry average, and also that this return is hopefully improving over time as opposed to decreasing. Next up on the list, we have the PEG ratio. This ratio is very important because it tells you how much are you paying for a particular stock in terms of the earnings that the company generates and is expected to generate in the future. The formula to calculate this metric is very simple. You take the PE ratio and you divide it by the expected earnings per share growth. What you're looking for this metric is that you're paying a low PEG ratio. What does that mean? That basically means that you're paying a low price for that particular stock relative to the current earnings and the expected earnings of the company. If you're able to do that, then you're in a very good position to have found an undervalued stock. Next up, we have the debt to equity ratio. This number is very important because it tells you how much debt a particular company has relative to the equity that it owns. And this is important because if a company has too much debt, then it may not be able to pay it off, go bankrupt, and then this is going to be really bad for your investment. To calculate this number, you take the total debt and you divide it by the total shareholders' equity. What you're looking for in terms of a number is a number lower than 1. And the reason why is because this means that the company can easily cover its debts by just using its equity, which is a very healthy indicator of a good undervalued company. Next up, we have the price to free cash flow ratio. This metric is very important because it tells you the price that you're paying for a particular company relative to the free cash flow that that company is generating. Free cash flow is different than profit because in the profit calculation, you may have some items in there that the company actually didn't pay off in terms of a cash outflow. So the free cash flow is really important because that's the actual cash that a company is able to hold and invest or do whatever it wants with it. The formula to calculate the price to free cash flow is you basically take the market capitalization and then you divide it by the free cash flow of the company. What you're looking for is very intuitive. You're looking to pay a low price for that free cash flow of a company. If you think about it, this is very intuitive because generally what you want to do is get as much back as you want in terms of cash flow, but have to pay the least amount for it. So this depends heavily on the industries that you're analyzing, but generally look for the lower ratios. The last metric we have is the enterprise value to sales ratio. This ratio is very important because it tells you if you were going to buy the whole company, including its debt, including its cash, how much are you really paying relative to the amount of sales that the company generates. The formula to calculate this number is that you take the enterprise value of a company and you divide that by the sales, the annual sales of that particular company. And what you're looking for here is very similar to the previous metric. You're looking to pay the lowest price possible for the highest amount of sales. And this, of course, really depends on the industry. But if you can pay a low multiple of the enterprise value, then you're generally in a good stock that's going to yield good results over time. Okay, so the way that you get these key indicators for a list of companies is really simple. All you need to get is the Y-Sheets extension for Google Sheets or Excel in this case. And what you're going to do is you're going to set up a list of companies like this. Just make sure to use the Yahoo Finance ticker system so that way you can access the data. Then after that, you're going to enter the parameters or the key metrics that we want to get. After that, you have to select the period embedded in them. So for price, there's no period because price is just the real-time data. But for financial data like the ROIC, P ratio, etc., you could have a period. So the period is either TTM, which takes the trailing 12 months, LQ, which is the latest quarter, LY, which is the latest year. You can also enter a particular year, or what you can also do is enter LY -2, for example, LQ -3, etc., so that you get the previous quarterly and yearly values. After you do that, you select the list of companies, click right here on the Y screener function, which you can see right here on the Y-Sheets add-on. And then after that, select the list of parameters, click right here, click on get data, and this is going to get all of the data for you. And this is going to generate a bucket that's going to save the range of tickers and the range of parameters of your data. So you can always modify this, change the name if you want, so that way you always remember your bucket. And then from here, at any moment, you simply click on refresh live data, and you, as you can see right now, you just got the latest data based on the most recent price and so on and so forth. To know what data is available, you can navigate to this page, ysheets.io/available data, and then you can simply click on the screener data, and then from here you can search, or you can also just see all of the different types of data that is offered on the screener. You can click here to expand this, or of course use the search so that way you can get the data that you're looking for.